Have you ever wondered how great investors manage to survive market crashes, even when everything seems to be falling apart? Today, we are going to reveal one of the most powerful methods for winning in the stock market, and best of all, it does not come from complicated theories or Wall Street experts. This system has been tested, simplified, and explained by one of the most successful investors of all time, Ray Dalio, the creator of one of the largest investment funds in the world, Bridgewater Associates. Dalio has perfected a formula that will allow you to protect your money in any circumstance and, at the same time, make it grow steadily. This method is so solid that when the entire market shakes, your portfolio remains firm. Can you imagine having a strategy that works regardless of whether the economy is doing well or badly? Well, that is exactly what Dalio proposes with his famous permanent portfolio. This is a plan based on a specific combination of assets that, if followed, will allow you to successfully navigate any financial storm. So if you are looking for a strategy that will make you feel safe in the stock market without losing sleep over market fluctuations, this information will be useful to you. Before we dive into Ray Dalio's method, it's crucial to first understand who this man is and why we should take what he has to say seriously. We're not talking about just any Wall Street investor. Ray Dalio is a living legend in the financial world. His history and experience have put him at the top of the game. He founded Bridgewater Associates in 1975, an investment firm that, under his leadership, has managed billions of dollars. So you could say this guy has been playing in the big leagues for decades. But what really sets him apart is not just the money he has made, but how he has made it. Dalio is not your typical investor who is guided by hunches or passing trends. His approach is almost scientific. He studies the economy and the markets in a very meticulous way, analyzing data, cycles, and behaviors throughout history to understand how they move. He is not interested in guessing which stock will skyrocket next or in following investment fads that can disappear at any moment. His goal is much more ambitious: to have a system that works in any economic scenario. And who wouldn't want that? We all dream of finding that strategy that allows us to make money regardless of whether the economy is doing well or badly. This is where his famous permanent portfolio comes in. Unlike many strategies that try to predict the market and focus on guessing which asset will go up or down, the permanent portfolio takes a much more stable and forward-looking approach. Instead of taking unnecessary risks trying to get ahead of the market, Dalio proposes to be prepared for anything. Whether it's a recession, an inflationary crisis, unexpected growth, or even an economic depression, his method is designed to keep you protected no matter what comes next. And how does he do this? With asset diversification. The basic idea is that you can't rely on just one type of investment because the market is unpredictable. Instead, you need to have a balanced portfolio that will allow you to navigate any financial storm. It's not about guessing the future, but about preparing for any possible scenario. This is exactly what Ray Dalio has taught time and time again. It's not about being smarter than the market, but about being more prudent and always being ready for the unexpected. What is the permanent portfolio? It's based on diversifying your money across 4 main asset classes. Why is this so important? Because each of these assets responds differently to economic conditions, meaning that when one loses value, another is gaining, balancing your portfolio and keeping it stable. It's basically a strategy designed so that you don't have to worry about the ups and downs of the market. The 4 pillars of the permanent portfolio are: 1. Actions. When you think of stocks, you think of economic growth. And that's because, in general, stocks do well when the economy is strong. Companies grow, their earnings rise, and investors benefit from that. They're the asset that performs best in times of economic expansion, when everything seems to be going swimmingly. However, in times of crisis, stocks can suffer big falls. 2. Bonds. Bonds are a type of loan you make to governments or companies, and in times of deflation or when interest rates fall, these bonds tend to rise in value. They are the perfect counterbalance to times when stocks are not performing well. When the economy is in a downturn and investors are looking for safety, long-term bonds become an attractive option. 3. Gold. Gold is known as a safe haven. Throughout history, it has been the asset that investors turn to when there is uncertainty in the markets or when inflation is high. In times of economic crisis or political instability, gold tends to maintain or increase its value, protecting your money from the negative effects of these scenarios. 4. Cash. While cash alone doesn't generate huge returns, it does provide a layer of stability in your portfolio. It's what allows you to have liquidity in times of high volatility. When the market becomes unpredictable, cash allows you to react quickly and efficiently. You don't have to sell assets at low prices or make desperate moves. Having a cash reserve gives you the peace of mind that if the market crashes, you have the margin to hold on and, better yet, the opportunity to take advantage of dips to buy at low prices. If you find today's content interesting, remember to leave your like and subscribe so you don't miss the next video. Let's continue. According to Ray Dalio, each of these assets reacts differently to different economic phases, and when combined, they form a solid strategy that helps protect your money. The question we must ask ourselves now is, what are these economic phases? Let's start with Phase 1. Economic growth. This is the ideal scenario, where everything is going well. Companies are making money, people have jobs, consumption is increasing, and markets tend to go up. In this environment, stocks are the big winners because when the economy grows, companies increase their profits and investors get good returns. Phase 2. High inflation. In this scenario, prices rise and money loses value because everything costs more. This is where cash and bonds lose strength, but assets like gold shine. Why? Simply because gold is seen as a safe store of value when cash loses purchasing power. Therefore, during times of inflation, gold protects your money by maintaining its value while the rest of the economy falters. Phase 3. Recession. This is the scenario where things are not going well. The economy slows down, unemployment rises, and companies earn less. In times like these, long-term bonds tend to take the lead. This is because when the economy falls, central banks usually reduce interest rates to stimulate activity, and that makes bonds more attractive and profitable. Phase 4. Deflation. Although it is less common, deflation can occur, and that is when prices start to fall. This can be a symptom of a prolonged recession, where demand for goods and services plummets. In these cases, cash is key as it maintains its value while other assets, such as stocks, can be severely affected. By holding cash at these times, you have the opportunity to buy more goods and services with the same amount of cash as before. As we can see, each of these scenarios affects assets differently, and this is where the magic of Dalio's diversification comes in. If your portfolio is properly distributed among these assets, you can be sure that at least part of your investment will be doing well, no matter what phase the economy is in. Now that we understand assets and different economic scenarios, how do we put this strategy into practice? The key is in the proper allocation of the 4 types of assets that make up the permanent portfolio. Ray Dalio suggests dividing the capital as follows. 30% in shares. This part of the portfolio includes a mix of domestic and international stocks. Stocks are known for their long-term growth potential, although they can be quite volatile in the short term. The idea is that by being diversified, some of them can shine even in difficult times, while others may not. 40% in bonds. This is where security plays an important role. As we said before, in times of deflation or recession, these bonds are essential to protect your portfolio, as they act as a buffer amidst economic turbulence. 15% in gold. Gold is like that loyal friend that is always there in times of crisis, as its value tends to rise when currencies lose purchasing power, making it an essential hedge against inflation. 15% to be kept in cash. It is essential to stabilize the portfolio by providing liquidity and security to it. By following this structure, your portfolio will remain balanced. If stocks take a downturn, bonds or gold can offset those losses. And if inflation takes off, your exposure to gold and bonds will protect your investment. So, by building the permanent portfolio in this way, you create a system that can adapt to any economic circumstance. After looking at the theory of the permanent portfolio, let's move on to a practical example so you can better understand how this strategy works in real life. Let's say you have $20,000 to invest. The first thing you would do is split your money between different assets to cover all bases. You would put $6,000 in stocks, probably in an index fund like the S&P 500 or some fund that tracks the global market. This would give you exposure to the world's largest companies, with the potential for long-term growth, although there may be ups and downs along the way. Next, you would invest $8,000 in long-term bonds, such as the famous U.S. Treasury bonds, which are known for their safety and stability. These bonds tend to rise during economic downturns, making them an excellent hedge during tough times. You could also put $3,000 into gold, investing in an ETF that tracks the price of gold, or even buying physical bullion or coins if you prefer to hold the metal in your hands. Finally, you would leave $3,000 in cash in a savings account, which generally offers low returns, to maintain liquidity. This would allow you to access money quickly if an opportunity arises or if you need to cover an emergency. With this distribution, you would be ready for whatever comes: recession, inflation, deflation, or growth. But then, what average annual returns has this investment method given? From 1972 to 2014, 42 years of history, it has an average annual return of 9.22% and a standard deviation of 8%. The most surprising thing is that its worst streak or year has been only minus 6.13% in that entire period. This is a perfect portfolio for calm people who do not want complications, since this is a very easy strategy to manage. You don't need to keep an eye on the market every day or worry about ups and downs. Once you've built your portfolio, all you have to do is rebalance it from time to time, perhaps once a year, to get your investment ratios back to where they were at the beginning. This strategy also helps you control your emotions when investing. In times of crisis, many investors panic and sell their assets at the worst possible moment, losing a lot of money. With the permanent portfolio, you know that there will always be a safe part of your investment, which gives you the calm necessary to not make impulsive decisions. Finally, this strategy has been proven to generate consistent returns over time. Don't expect to get rich overnight, but as you've seen, it does guarantee stable growth and, most importantly, protects you from big losses when the market falters. If you are looking for a strategy that allows you to invest like the experts do, and at the same time sleep peacefully knowing that your money is safe, the permanent portfolio is an excellent option. Are you planning to follow this method? Leave us your answer in the comments. If you like this content, remember to give it a like and subscribe to the channel so you don't miss the next video. See you soon!